day in the way that we go about it. Now, what I would like to say is that in order to get the most out of this, a few guys have had a few follow-up sessions, follow-up discussions with me. These are more guys that I relate to. And they said I need to focus just a little bit more on explaining the bar-by-bar price action that has taken place when I get into the market. Like now we're in the market, we are an hour and a half on my time zone into the US European session. So we need to have a look at that and just unpack it a little bit. The other thing that came up is guys want to just have a look and see what I look at. What am I seeing in front of my charts on my screen? So what you have on your screen right now is exactly the screens that I'm trading off. So there are those four markets that you're looking at. At any given time, I can just, even if I walk away and come back, I will have this quick view to have a look at and tell me what the market is doing and whether I should now be looking for executing a strategy or not. So what I have is three currencies. There's Euro, Dollar, USD Yen, USD CAD, and then gold on the bottom right. These are 5-minute time frames, 5-minute charts. Obviously, I've done the daily setup, which I'll take us through. And based on the daily setup, again, at the back of my mind, I always have, it's not 100% bias, but it's my early sense of where I think the market could go. But I try not to fix a bias in my mind, because if I do that, one of two things can happen. If the market goes in the direction of the bias, fantastic, I'll be able to make good money. But if the market goes against my bias, even if at the end of the day I look back and I look at the charts, if I've been stuck in a bias, I find it very difficult to take good trades. And I could sit there or fumble my trades, if I call it that, not manage them correctly. And I've learned over time that an early bias, as I call it, is good, but as price action unfolds, the more time that goes into a particular session, I fight hard to maintain a position that says, what are the bulls doing, what are the bears doing, who is in control of the market, and which direction should we go. So bias is good, but don't get stuck in the bias. Another thing, guys, just a quick apology, there's construction happening around me. So there is banging taking place, and I hope it doesn't disrupt us. I have asked the guys to try and keep it to a minimum, but these are contractors. So they got to press in and carry on. So here's what I want to look at. So in fact, what I'm going to do is I'm going to look at the daily setup very quickly and just recap for those of us who are joining us for the first time, how I do my daily setup. Then we're going to spend the first part of this looking at just the bar-by-bar price action that is unfolded, and we'll look at it from the Asian session. Now, obviously, because of time, we can't look at every single of the four products in detail, but you get a sense of where we're going. I'll focus a lot more on the bars in the current session, but then we'll go back to the previous bars as well. That should take us for the first half of the session. Then I'll jump to the profitable trades that I want to talk to you about from last week, which will just work through the logic that I went through, and then we'll keep our eyes peeled for always what's happening in the current session to see if we can take any trades as we go along. Now, the other thing that I'll be introducing, I think I may start next week, is just look at some of the losing trades that I've taken. Although I've shown you profitable trades, there are losing trades. And when losing trades occur, I'm always interested in finding out, asking myself, did I execute the trade as per my strategy? If I did, then I'm very happy, absolutely happy with myself. But if I've lost and I've not traded according to strategy, then that's a big problem, because that means there's something happening in my psychology that I need to address very quickly, because I should not be executing any trades outside of strategy. So we're going to have a look at that. So let's have a look at the euro very quickly. Okay. So I'm going to pop up the daily chart very quickly just to show you something. All right, so you see, and these lines here, the red horizontal, the green horizontal, those you are definitely going to see when you get to the 5-minute time frame, because of the pull down there. And that's the high of yesterday and the low of yesterday. So that's the most recent setup that I put on my daily, and that light magenta is the open of today. So you can see that we're right up against the high of the day. If you trade the daily time frame, don't know if you want to be adding on to trades or not, that's up to you, but we're right up against the high of yesterday, which is bullish price action. But what I want to point out for us is this. There is a level here, which 1.19916, 1.2, etc., near that level, that the market broke through, came back, did a pullback and tested that twice. So we had a double top there, right off the moving average, and then with price continuation. Right at the beginning of this show, I did speak about leg one pullback, leg two. So I'm not going to spend much time on that, but that was a two-legged move. First leg, pullback to the moving average, double top would have been fantastic if you're taking a trade. Put your entry there, and then your stop up there. Then wait for the leg two to complete, because market tends to do these two-legged moves. Now that level is a significant level, so I've marked that here so that when I'm on my 5-minute time frame, I can see that coming into view, because the bears who created the bulls tried to break up, and the bears forced the market to turn, and the double top was created. Those bears may be waiting just to get to that level to defend that level. So the market gets there and it starts to turn, and I see double tops, lower highs, etc. off that level, then I know it's a strong level that I gotta be hoping will hold, and see if I get entries. And what kind of entries would I be looking for if I start to get double tops on the lower time frame? Okay, off this level, the market may be wanting to come back and create a higher low here. Okay, or long term, it might just come back all the way down there. So I always mark those key levels and leave them on my 5-minute time frame. So that's about it. That we want to have at that level on the daily. Just want to show you. So there is the 1.19 level that I marked. That's a very significant level from. Now, here's where things start to get interesting. So, the market has come back. This is a form of a range. Here we tested the high of yesterday. We're attempting to break through that. With a minute to go, so we might close beneath that. Might want to test the open. Let's see what the market gives us. But what is interesting is that a measured move, if the market turns here and breaks above the trading range, a measured move above this trading range would bring us back to that level. So that indicates to me that the price action unfolding here is taken into account that level. That's why the measured move, if we broke above that, would likely get to that level. Now, are we going to get to that? Well, we have to wait and see if we get double bottom somewhere in this area and a decent setup for us to then trade. Now, when I say double bottom and then a decent setup, I think it's important just to bear in mind, and I've said it before, I always want to see a distinct pattern unfolding. So in this case, we're talking of a double bottom. I want to see a double bottom to test of a particular level. And once I see that, I want to see the market then coming back to create a higher low above that, and that becomes a tradable setup. So the creation of the double bottom itself is not a setup that I'll be trading. So let's keep our eyes here. Now, what else could happen? So we have a breakout candle. That's good. Remember, in terms of breakout, I always want to see a candle breaking out beneath the pattern. So it's breaking out, beneath this trading range here. But I need to see a follow-through candle that confirms the breakout. And once you get a follow-through candle that confirms the breakout, then you gotta wait for a pullback. And wait for a pullback. It's a strong breakout to the 10 moving average or to the 20 moving average, then look to trade there. So here's what could happen. If this breakout is confirmed as follow through, and then we have a pullback, you can take that trade. We can determine where to put our stop, but our initial target will be the measured move of the breakout beneath this trading range. So this is a trading range. Market came up from this side, came down, went up again. So that's a trading range there. So let's, we'll come back and see if we get a confirmed breakout. And then all we want to do is wait for the pullback. And if you get a pullback, then happy to trade that trade, take that trade. So that's kind of where we are with the euro at the present moment. Let's have a quick look at the CAD. USD CAD measures and trading measures. So again, just very quickly, there's a daily setup. What can we see that's interesting here? This is interesting in terms of what kind of bias do you have. Now, the fact that we had a big bear candle yesterday, closing almost near its low, would that give you a bear bias? Well, the bears were strong enough to control the market for the day. But have a look at a few candles back. Again, with bears strong enough, there they actually triggered a sell, closed on or near the low. And if you're a bear, you'd have said, listen, the bears are strong enough. We just want one more candle to close beneath this, then the market is going to track all the way down to there. But immediately following that, decent reversal, low test, reversal candle by the bulls. Then we had yesterday's candle, and we're back here. So it's three candles going sideways, which is a trading range. So it's very hard to set your mind and say, well, it's completely bearish for the day, so I'm just going to look to sell. Because of what happened here, of this intermittent candle. So yes, we close to the low. If the bears are able to close beneath this, then they really have to have momentum to carry on to close beneath here. On a 5-minute time frame, if the bears close beneath here, by the time they get to this level, you'd have made decent enough money. There could have been a decent trend for you to trade, or whatever patterns are set up. So let's keep a look at that and see what we get. Again, in terms of asking yourself what could happen with the market, that's what you're going to continually ask yourself. What could happen? What could happen? What could happen? If we had a break beneath this trading range pattern here, we could come down all the way down here. 27 pips, 30 pips. There's enough pips for you to make money with proper stop sizing. If you broke above that, that's how far we could go. Now, remember, measured moves are areas where if you're in a trade, you should consider taking profits. Either take full profits or take partial profits, because the market is likely to turn there. If you have your stop way down here, we're down here, you're taking a trade and there's a higher low, you manage to put your stop at the next level, minimize your risk. By all means, if you want to hold and see how far the pullback goes before the resumption, do go ahead and hold. But always remember that if you are not in a trade at a measured move, you must watch to see what the price action does. It might be the beginning of a reversal. Now remember, always all reversals start off into trading ranges. The market always enters a trading range first, and out of that, you might get trend continuation or reversal. Quick look at the yen. Okay, so there we are on the yen. Yesterday's low, yesterday's high. I'm trying to open this up. You can actually see the day's candles just in here. It's on the daily time frame. The peak movement is still quite low, but yesterday's low, yesterday's high. Now, yesterday was an interesting candle because it triggered a sell. If you're looking to get in a sell on the daily time frame. But the question you have to ask yourself, okay, the bears were strong enough, good to trigger the sale, but why weren't they close enough to close beneath this low? Okay, so here buyers short, but just have a flag in your head to say, why were they not strong enough to close beneath here? Maybe the bulls who created this double bottom are the ones who are in the market, because the bulls want a reversal here and the bull trade to resume. Things to keep at the back of your mind when you are trading. But when you drill down to your time frame, you trade the time frame that is in front of you. So in the 5 minute, this is our time frame, and that's what we're looking at. That's what you're gonna wait to see. We'll come back and have a look at that. Quick look at gold. Let's look at the daily time frame. Okay, again, yesterday's low, yesterday's high. There is the day that's unfolding within that. Okay. I think it was last week when I mentioned that I'm bringing gold onto my charts, and we had the double bottom. And I said on the daily time frame, double bottom, but I wouldn't trade that. I would wait for higher low. So the question is, could this be the higher low if you trade in gold on the daily time frame? Undoubtedly for me, that would be a higher low, but if you're taking that on the daily time frame, if you're taking this kind of pattern on any time frame, you'd have to enter above here, and your stop has to be down here. That's where the stop goes. So you got to decide: are you able to put that much risk in? Trade small so that your overall risk remains the same. If you can't do that, wait for the market to break out above that, pull back, and maybe you can still have a tighter stop. Okay, at that level. But gold, talking about bias on a longer term basis, it's bullish for me. So when I get down there, although I don't get married to my predictions and my bias, it's something that I keep in the back of my mind. Interesting just to bear in mind. So you can see this pattern. It could become precise way to put it, but okay, so if we do carry on going down, it might come down here, which might give us a double bottom. Now, you might be asking, well, okay, the market is going down, but why would you not be trading? Because if I'm trading a bear trend, a bear move, either I'm trading a bear breakout, so I need to see my breakout candle. So that's a breakout beneath that follow through. Or we wanted to see a pullback and then off the moving average. Or if it's a trend, then I'm just going to wait to see if I get a decent pullback off the 20. Now, off the 10 moving average is the breakout. Okay, so the strongest move, the breakout, I look to trade the pullback from the breakout off the 10 EMA. But if it's just trending downwards, then I'm more comfortable looking for the trade off the 20 moving average. So in this case, there's nothing for me to trade bearishly at all. We must not ignore this low that we have here from the earlier session. Okay, so what I'm going to do is just take a look at my watch. If we have a look, let's just start off with the bar price action that has taken place right from the beginning of this current session, the European session. So I just marked 5 minutes before the session starts, so I can see what happens with the very first candle. It's a bull candle, which is good for the bulls, but for me to have been comfortable with my bullish bias, I would have loved to see this first candle as a strong candle, closing above the moving average, preferably closing above the opens. Remember that light purple, light magenta is the open. But the bulls failed to do that, so that question mark I always have above my bias comes in. So I'm just patient to see. I'm not going to jump into anything and say, well, listen, we see some bull candles, let's jump in and see what happens. So these levels here become quite significant to see what happens. And as you can see, the market turned. Why, you may ask, okay, the market is 10 there, is that not, are we not into a trading range? Why aren't you taking that trade? I mean, are we not going to take a trading range trade? Well, a trading range trade that you take, you'll have to see the double top, and then you have to see the double bottom. And if you saw the double top and the double bottom, and so the double top and the lower high, then you take that. But I didn't see that. I see a double top. I don't get my lower high for me to trade, and already I'm at that low. So there's not much momentum. There's not much pip movement. There's no confirmation, nothing that says to me, George, jump in and trade this because we're going to go all the way down. So it's best to bite your fingers, do whatever you want to do. Don't jump into it unless it's crystal clear. Because if you do that, you're going to end up just taking trades. When you take a wrong trade, here's something else to mention. When you take a wrong trade, is a trade that doesn't fit into your strategy. The emotional energy that you exert to manage that is going to distract you from taking trades that are within strategy. And even if you do manage to manage it and come out with a profit or not money, you will find out that when you look back at your charts end of the day, what you must do is that you would have made a lot more money by leaving that trade and waiting for trades that fit into your setup. So there's a high there. There's another high there, which is right by the high of yesterday. So it's a double top, but I'm not going to trade that. I want to see when a double top forms. You just want to say, okay, there's a double top. Let me wait. There's a lower high. What happens after the double top is absolutely critical. The double top has formed, which means the bears are strong. Correct? If the bears are strong, then I want to see that reversal candle. I want to see a follow through. I want to see strength. I want to see strong close beneath the moving average. Then start to go back and give me my lower high. When you look at that, forget about all of this 11. Does that show you bear strength? It doesn't show you bear strength. So which means whatever forms, don't take it. So when a pattern forms double top or a double bottom, what happens immediately after? Is there strength that the guys will form the double top, that's the base, or the double bottom? So it is, then confidently wait for your lower high in this case, or higher low for you to take a trade. That's how you increase the probability of success. I mean, if you want to jump in and trade and just say, okay, I will scalp, which means I'll just take a few pips all day long. If you have the energy to do that, by all means, if that is your strategy, then go ahead and do that. If it's not your strategy, don't do it. The market is very alluring to pull you in, but the biggest impact will be on your psychology and your ability to manage setups when they come. So this for me is brilliant. I want to see, are we going to get a double bottom here? Okay, remember what's happening on the daily time frame. I want to see if we're going to get a double bottom here. Okay, if you get a double bottom here, and immediately after the double bottom. So try and visualize, see what we have here, these few candles here. If this occurs again here, you get the double bottom, get a strong candle closing above the moving average. There is strength after my double bottom is formed. Then all I want to wait for is a pullback, a higher low, and a trade. If this kind of thing repeated itself, if we get something like this here, whether it's now or later, then we could take that kind of trade with our stop down here. Don't put a stop here, put your stop down here. But see the double bottom, see the strength, and then see the high low. Then you can take that trade. So we'll come back and have a look at this and see what forms are. So the yen, okay. Okay, sorry guys, just to keep a bit of order to it. Let's have a look at what happened with gold in the Asian session, so we don't bounce around. Okay, so depending on what time you'd have come into the market, I usually want to come in at the time that so I'm coming in around here. Okay, I like to come into the market at the time that the Tokyo Stock Exchange, the first 2.5 hours, actually opens, and immediately I have a look to the left. Of course, you have seen what's happened with the US session, what's happened from the open of the day, just to get a feel of it. But I'm very interested in what's going to happen as we open this particular session. So the first candle that opened was a bear candle, a very good bear candle. The second bear candle, the second candle was a follow-through candle, strong candle closing beneath the moving average. So fantastic demonstration of bear strength. In order for me to I'm really sorry about the banging. It's just the construction works. It's a little bit beyond my control to stop, despite having asked. My apologies for that. I should have changed office actually, but I missed that trick. I should have traded from a different place completely. So my apologies for the banging. In any case, in order for me to have taken any trade here, that candle is a breakout candle. It's breaking out beneath this candle and beneath the moving average. I need a follow-through candle. Whenever you see a candle breaking out of something, and it's a decent candle, wait for the follow-through candle. That would be a trend candle in the direction of the breakout. So if I had gotten that candle there, then I'd wait for my pullback, and I'd have been happy to trade the pullback. But at that point, these two back candles are good enough for me to maintain my bias that the bears are strong. Now, market went sideways, and then what we had this bullish price action. Now, that completely reversed the back price action that we had. But if you had been in there, if you had been in the market, and if you had put your measured move, you would not have been surprised by that move. Let me just check here. Oh, thanks, John. Appreciate your support. Thanks. So if remember measured moves, if you can track back to the archives and find where I spoke about measured moves and leg one, leg two extensions, it's absolutely critical. So you have seen the bear move, and then you have the reversal, okay, the reversal of this pattern. But how far does it go? It doesn't surprise you, right? Because a measured move would get us there. It was also a test of yesterday's high, and then you have the bears coming back in. So again, your bear bias would have remained. So measured moves, where the market is going, reversals at that should not surprise you and should say to you, okay, market is moving in the direction. Let's see if I can find an opportunity to trade. Here, I would have taken that. You could have, if you wanted, I would have waited to see if I get a pullback to the moving average, because that's my breakout, follow through, pullback. That would have been a good trade to take. But if you take that trade, your stop has to go up here. Okay, that's where the stop takes. Whenever you take a first pullback trade out of a breakout, a test of the moving average, you have to go to where the breakout began. So that's the best place to put your stop. That's most conservative. You could put it here. That's where you can say breakout started. But don't put your stop here. The only reason is you get stopped out, you get frustrated, right? You put the stop there, etc. Then it sets up again, and should I take it? Should I not take it? This time you should be taking a stop and put it in here. You're going to end up missing the opportunities, right? So try and put the first stop after breakout at the correct level. So in any case, reversal at a hidden support level. Test of yesterday's high. Bears are in the market. Don't take that first trade because of the strength of the bulls. Just allow the bears to create a pattern within there. And there's your pattern leg 1, 2, or that's all leg 1 pullback. Take a trade. Then you can do a measured move, like we've spoken about before. Okay, measured move will be there, but the market didn't get there, or you can do a leg 1 and leg 2. So then, once you're in there, what are you looking for? Okay, the market is going down. I need to, now the bars I'm looking for, the candles I'm looking for, what I want to see is bear strength. I want to keep saying to myself, do I continue to see bear strength? Okay, so because it's going down, right? Your bar by bar analysis is going to be looking for, number 1, bear strength, and number 2, when I see bull strength, are the bulls being repelled or turned back at obvious support levels, at the moving average, or if I got hidden level of support? What is happening every time the bulls come into the market? What happens? Bulls come into the market, they turn. Bulls come into the market, they repelled at the moving average. Bulls are turned, they fail to break out. Strong bear candle, strong bear candle, strong bull candle. You're seeing consecutive bear candles. As you train yourself to say, what am I seeing in terms of the bars in front of me on the chart? Am I seeing candles or bars that are confirming the direction of the market, and am I seeing strength? Are they coming off a level of support or resistance? That will give you opportunities to trade. Now, having taken that or missed a trade, you could still take that particular trade there. You could take that, but your stop has to be there now. You wouldn't have been stopped out. Or you could take that stop is there, or you wait for another test of a moving average, strong candle, put it beneath there, may not have been triggered until the next candle, off the 10 moving average. Beneath here, you could have many opportunities you could have taken. You don't take all of them, but I'm just saying there are opportunities for you to take a trade. If you want a more safe, secure, that's a wrong word, a more safe, higher probability way to take a trade in a trend, when the market is moving down, wait for the test or the bounce off the 20 moving average. There is a bounce off the 20 moving average. There is usually at least one good one. You could take that and you look back to your left, where is the previous lower high, put your stop here. Remember, you're trying to get to this level. Let me just check the question that's in there. Yes, good question, Gary. Yes, the 5 minutes before the Tokyo 255 and 1055, they do change. So before the daylight saving, it was 155 and 955. So an hour back. So they do change. So what I want to do is just get in 5 minutes before the market opens. The US market currently, I'm going at 3:25 my time before the New York Stock Exchange opens. So that's what I'm going for. Yes, they do change. And also a good guide is just look at the time on your MT4 and compare that to when the market actually opens, GMT, and then use that. So I'm throwing a lot of things here, but in terms of bar by bar analysis, for now, when the market is moving in a direction, and obviously we've seen why it's moving in a direction, right? We looked at our open, we're happy with that. We didn't get a successive candle for us to start to trade earlier. With the reversal, we don't panic or try and start to go long. We know that's a trading range there, measured move, okay. The market didn't break above the trading, above the measured move and pull back. So we're happy with that. Then the market is tracking downwards. So the market is tracking downwards. Now I'm looking at the bars that are confirming the direction of the market. In this case, it's bearish, confirming bear strength. Are they coming off moving averages? Is there like in this case, we get a double top as a lower high. Are we in a trend? Those are now opportunities for you to trade. That's what we're looking for. In the same vein, when I look at the candles or the bars that are coming up, counter trend, the bulls, I see them, but I'm asking myself, what is happening to them when they get to a level of support, a level of resistance, in this case, off the moving average? Off a previous lower high, off the open of the day, off a hidden support. And you see that, yes, strong bull candle, but they've been repelled. Now, here's something quickly. I want to just make sure I've got time to go through to those trades. So from this back candle down to here, we've got a trend line. Oops. We could have even marked it from there. It kind of broke above that. The 10 moving average, the 20 moving average, those are all trend indicators. So I want to put something else in terms of just where we could take our profits. Okay, remember we spoke about leg 1, leg 2. So there's the first leg of the move. And the second leg started there, or you could say the second leg started there. So in terms of profits, the most beautiful profit we want is if you get a full measured move down to here. That would be absolutely fantastic. But the market turned before that. But in terms of our first leg, where is that first leg? Pullback started there. There was the profit target. So within there, if you have not set, the reason to go for measured moves is just, we don't quickly set one-to-one profits because you might get more than that. But if you're going away and you can't watch your trades, find the most conservative profit target, which is that one. Just put a few pips above that, put your take profit, and take your profit. If the market breaks beneath that and you're not there, that's fine. You've banked some profits. In any case, when you got to that level, I'm trying to avoid going into measured moves because there's a lot we can talk about. I'm just going to put it in for now. So I think we probably, you see that there is another trading range here. Why do I say that? Market was this low high, went down, went up, came back, went sideways, and tested moving average. It's a sideways price action. I mean, if you were just to cast your eyes up to here and forget about all of this, if the market went up from here, you say, oh, okay, we're at a trading range, double bottom, and the market went up. So that is a legitimate trading range. And if the market breaks beneath the trading range, it might get to a measured move. So we have super duper profits, medium profits, and more conservative profits. So if you can't watch your trades, put your profit, take profit here, and just go. Even if you're watching, just you can take some profits there. You can take all of it there, and still be able to add in to your trade. But in any case, when we got here, the market turned, and if you're still in trades, you may have to try and get out here or get out on that close. if you haven't taken your profits at that level. At that level, you really ought to be. I mean, you can see that low test candle. Why are these low test candles created out of nowhere? It's not nowhere. It's all of these measured moves that we're marking. Market can then turn because that's where the institutions are taking profits. So that's where you ought to be taking profits. But if you've left it in, if you've seen that and not taken your profits, you follow through and the market turns, you've got to be taking your profits at that stage. Because if you don't, you'll take them off here, still make some profits, or if you took one day, make a bit of a loss. What I want to do, guys, just quickly, I want to go to the 8th of April on 3 currency charts. I marked them earlier on. Okay, and just show you trade that I took. Now, this was I usually talk about the Asian session and the European session. This was slightly different. This was into the US session. It's current times now. This is 1800, so that's the time that you also have in MT4. So I wasn't able to get into the market much earlier on, but I had a chance to come in and look and see what's happening in the US session. So let's see if we can get a few opportunities to take trades. And as it turned out, things turned out quite well. So clearly, you could see bullish price action, market going up. I wasn't in the market, but when I came into the market, I could see what had been happening. And now I'm seeing the market pulling back. So ignore these horizontal lines. These are lines that we've marked for today. So they've not gone to what we had. But when I came in, I'm saying to myself, well, the bulls are pretty strong, and we're now into the US session. So my mindset is going to the US session. Are we going to get a reversal that is going back to test the open? So we end up with a doji candle on the daily, or whoever has been the dominant force during the day, are they going to maintain their strength? So we end up with a bull candle closing on a its high, or if we're bearish, a back candle closing on a its low. So at this stage, I'm looking and I'm saying, well, unless I see a clear bear reversal, I'm going to keep trading with the trend and see what we get. Now, one of my strategies is called major trend reversal, and there are steps to that major trend reversal. First, you need to have a trend, a strong trend that you see. Then, what you need to see is a break of the trend line. In other words, you need to see the last dominant trend line breaking. Then after that, you need to see the bears, in this case, put in a strong close, a full candle beneath the moving average. So moving average get bar, a bar that's completely beneath the moving average if you're coming from a bear trend, or a bar that's completely above the moving average if you're coming from a bear trend. Okay, so from a bull trend, you see the break of the trend line. I want to see if there is going to be a candle that's beneath the moving average. Then from that moving average get bar, which we got here, I want to see, and I'm expecting the trend to resume. The bulls who have put this trend here, okay, who are strong enough for that whole trend, those bulls, they obviously would want the trend to resume. I mean, if you're a bull, you know there'll be profit taking at some stage. You know that the bears will try and come to the market. So at most, this could be profit taking, okay? Because if you look at it, I don't see strong successive bear candles. So if I'm a bull, I'm saying, okay, there's been some profit taking. Now, there is a moving average gap bar. There is a candle completely beneath the moving average. The bulls attempted to reverse that, attempt again by the bears with another gap bar to resume the bear trend, failed. Then you get an outside candle, an inside candle, and an inside candle. So at the moving average gap bar, okay, out of a strong bull move, bulls want to see a resumption to try and test that high. So the ingredients are all in there, but you always need to see a pattern. Remember what I've said, when you have a double top, don't trade that, wait for the higher lower high. When you have a double bottom, don't trade that, wait for the higher low. So there is my moving average gap bar, very happy that there is a reversal by the bulls, which is also a double bottom. This happy with that, but now I need to wait for the setup to trade. And I had in one of my patterns an almost perfect setup. It's an inside candle. So with an outside and with an inside. So inside pattern. An inside pattern is a breakout mode, which means in the direction that I'm anticipating the trade to go, I might have a breakout. Okay, 60-70% probability. And the whole point of that is if I have that pattern in the correct place, then I must take the trade. It's a breakout mode, so I expect it to break out in the direction of my trade, which is what happens. So I put my entry above that because an inside pattern breakout mode, and it's going to break out. I had a tight stop on that, and I was waiting for the market to see if I get a test up here. Market carried on and it turned. I didn't get the test up here. So when the market began to reverse here, that's when I closed my trade. So you know what I was looking for is a test of up to here, okay, and if possible a breakout, or if it was a reversal up here, I would have taken it out. But you know, yes, I had some profits which I let go, and the market turned back. And when it started to come in this direction, I was thinking lower high, so I closed my trade there. That was just less than 1%, almost 1%. It was just less than 1% trade there. But out of a clear pattern, bull trend, moving average gap bar, double bottom, set up inside candle, take a trade, wait for the test there, okay, 10 before that, and I was able to close the trade. The other one I want to have a quick look at for you is the euro dollar. Okay, just in terms of what's happening currently, you know, on the euro, in terms of what you need to look out for if you want to stay in the market. At this stage, I'm expecting this whole pattern here. It's a lower high, a lower low, it's a double bottom, a lower low, double bottom. But I'm calling this because of how close it is. The whole setup is a double bottom. So I wouldn't say, okay, it's a lower low, double bottom, so let me trade that. That is a complete pattern on its own. So all I want to see at this stage is if the bulls are strong enough, they will give me one or two candles. I don't know how strong they would be. If I get two strong candles, one breaking above this, one breaking above the moving average, I'm just going to wait for a pullback test of the moving average, and I'll look for my long entry, stop down here. If we do go sideways, I am looking for a bit of a move up, come back, test the high of yesterday and the lower high. So what I'm looking for on the euro now is a higher low. So what I'm looking for is a higher low. Now, a double bottom, just as a note, doesn't have to be perfect. So you might be saying that, George, that's not a double bottom. Well, it technically is. We have another low down here, so we could say higher low double bottom. But let's look at what's happening in the session with the micro double bottom here. That whole pattern tested that double bottom and turned. So it's a lower low double bottom. Okay, double bottoms don't have to be perfect. Just keep that in mind. And because they are occurring, there's very few bars of separation. That for me is one whole pattern. So all I'm waiting for on the euro is a decent setup for a higher low. And if I get the higher low, then I'll look to go long. Of course, the first stop would be some profits. If the bears surprise us and give us a couple of candles beneath here, wait for the pullback of the moving average and let's see what happens. But let's have a look at euro on the 8th. As I said, next week, as we stand, I want to look at some losing trades that didn't go right, which are part of the strategy. Again, if you lose trades that are not part of the strategy, just kind of beat yourself up for a few seconds and just move on. If you win trades that are not on strategy, the very same thing, beat yourself up for a little bit, then move on. You better stick to your strategies. The biggest danger, as I said, just to repeat myself, of taking trades against strategies, what it does to your psychology. You get frustrated, you panic, you get upset, you make more mistakes. It can go horribly wrong for no reason except that you couldn't wait for your strategy. And if a session goes by, if a day goes by, if you trade in higher time frames, a week goes by, nothing's set up, that's fine. But on the 5 minutes, you will get setups. In every session, there is at least one setup that will make you some money. So in any case, again, that same day, I just marked this in yellow so you can find it easily. That same day, came into the market, euro dollar, and I'm saying to myself, well, what's happening so far in the market? Clearly, you could see the bullish price action. There's a decent breakout here. Okay, from this level, breakout, pullback, and maybe you would have wanted to trade that because of the way it's set up. You wait again, coming off the 10 moving average. If you take that, you stop down here. A very good trade off the 20 moving average. That one you have to just whatever you do, even if you trade a fraction of your risk, when you see something like that, after that, just take a trade. 60-70% chance the market will move in the direction. Another bull breakout, market goes sideways. Now, market is going sideways. Where is it going sideways to? The market is going sideways to the moving average. It's going sideways to the 20 moving average. So here we had a low test. And what was the market testing? Okay, so at that stage, market was testing a breakout point. The bears control the candle, but it's closing above its midpoint. Huge tail, so a good low test and close above the moving average, so bullish strength. You don't have to take it because of the color of it. If you want to take it, your stop has to be down here. If you want to take that at a much lower risk, but just to wait. I'd rather wait. So I'm in the market, I'm looking and saying, okay, I like what I'm seeing, but I want a higher probability trade. So off this, the bulls again, strong candles, but the candle at the top of that, they pull back again to the moving average. Two candles, two back candles. But I remember when I was speaking about on gold, the bar by bar, and there's two back candles. What is happening when the market gets to the moving average? That's what I'm gonna go ask, because we are going upwards in the bull market, right? So bull breakout. Look at all the bull candles, back candles coming, not consecutive back candles, but being repelled, bouncing off the moving average. Bear candles, not going to the moving average. Huge bear candle, immediately reverse, sideways price action. Dodges, bear candles, but nothing strong. At some stage, there was a strong bear candle, but turned. Strong bear candle turned. Two bear candles at the moving average, followed by a bull candle. I'm saying, okay, that's interesting. The bears are not strong enough to follow up on this trading range. Then again, similar pattern that we had, inside candle. So I have a doji, I have an inside candle, I have another inside candle. Whatever I do, whenever I see that in the context, I take a trade. Above there, beneath the breakout more. Had you not taken that trade, there is another classic trade. I like to call these old classicals. You get this every now and then. When you see this with the context right, if I hadn't taken that trade, I definitely would have taken that trade without any doubt at all. And where you're going to take your profits, well, measured move. Okay, that's the area to take profits. That's where you must look to take profits. So I had my entry in, I saw that, and I said, fantastic, when I get to measured move, let's see if I'll get acceleration. Sometimes you get low probability. But the market starts to turn, because the market starts to turn, I take my profits because of the measured move. That's a hidden level of resistance. I take my profits there. I mean, that was a very good trade. So, that was probably the big winner of the day. So whether you take it up there or taking it there, I mean, you could have taken it there, you could have put your stop there 6.5, you could put your stop there 13. That's 1 or 2 to 1 trade at least. And if you don't understand the breakout mode inside pattern, if you left it and you wait for that, that's a trade that should have taken coming off the moving average, and the context is correct. So CAD, we're still waiting. Let's have a quick look at the. Let me show you quickly the CAD trades before we close on the 8th of April. Okay. So again, let's just remove that. Again, the context quickly because of time. You can see bearish price action. So I'm coming off the market, and what I waited for was an L classic test. Just wait for test of the moving average. So we're coming off this lower high. So there we were coming from a bear trend, come back. Wasn't the market to trade that, but there's a lower high. Market resumes, come back, test that again. That is a lower high. It's also a double top lower high. It's a micro double top. In other words, it's a double top just within 2 or 3 candles. So very strong confirmation of bearish price action. The market is going down, lower high, market, double top. So when I came in, I'm saying, well, if I see a test of the moving average, I'm going to take a trade. So I put my entry beneath this trade because it's coming off the moving average. You could have said, well, let's put it beneath here. You could have put it beneath there. It's still a valid trade. Now, measured move. Excuse me for rushing a little bit. So where are you going to take that? So you could say there's the first move of the bear move. Okay, first move leg 1 to leg 2, and then that whole move, the pullback resumes there. So that's the possible area for taking the profits. You could also have put in a measured move. Okay, you see that low here and the high, the market breaks beneath this. It's a double bottom. You can see that if it breaks beneath that, it's likely to go for a measured move. Okay, so a potential measured move is within that area. So if you can't watch your trades, take your profit just a few pips above that. But I was in the market, I saw that and I waited, and then it started to turn. Here, that's when I closed my trade. So guys, so we've just taken it right to the wire. I rushed a little bit. My apologies with that. But next week I'll talk about some losing trades. And you can see where things go wrong. The other 40% of the equation, 60% chance of success, the other 40%, just to prepare our psychology in terms of our trade. Thank you very much. We shall see everyone next week.